Panagdait sa tanan. Panagdait, sir. So we are the group 6 and I'm Rochelle Lamasora and our co-members is Quenlake S. Carpintero and Melchory Jane de la Vega. So our report is the continuation of the chapter 7. Our topics is the distribution, the planning for sales and use taxes, levying and tax abatements, trade-offs with local tax incentives, infrastructure, government cost subsidies, and other local costs. And lastly, putting it all together, the seventh applied to market penetration in other states. So the distribution, the planning for sales and use taxes. The difference between the sales tax and use taxes. Sales tax is applied on the purchase of a good or services, while use tax is applied on the use of a good or service on which no sales tax has already been paid. Sales tax and use tax are mutually exclusive, so they'll never be placed on a transaction at the same time. It's either one or the other. So in the firm, sales personally property to end consumers. It may be required to collect applicable sales or use taxes from the customer. So if the part of the product include a service, the firm should segregate fees for the service, preferably into separate bills. So no sales tax need to be changed. So example, include the custom developed computer software and extended warranty contracts. The example of the sales tax include the retail goods like food and clothing, and the common services such as dry cleaning and hairdressing. And use tax also, the example of the use tax is the tools, the computer equipment, furnitures, and also the artwork. So businesses are required to collect and remit these taxes only if they have a substantial connection with the taxing jurisdiction. But if it fails to collect when it does have the required nexus, the firm is responsible for paying the tax to the appropriate jurisdiction. So as what we can see it, we have the selling firm, the customer in the same state. This is the sales versus use taxes, the two sides of the same coin. In the same coin, each does customer in the same state. And the sales taxes, yes, it is customer states. But in use taxes, no, because the use tax in customers state. Although they are intended to complement each other, there may be differences between a state sales tax and its use tax. and its use tax. So, for example, the sales tax rate may be slightly higher than that for the use tax. So, this often occurs because for administrative convenience, local taxes may be piggyback that is added into the state rate. Example of these is include the rapid transit and population control taxes. So as what we can see in the example of 7.12, this suppose a company send inventory via a drop shipment. So the state is the firm located and the state be it is the subsidiary with warehouse located. Then the customers located are in state C. So the use tax is due in state C. That is where the good is used. So we have already talked about the nexus rule. Then so in the US, the nexus rules is a firm net collect sales taxes unless it has a substantial physical presence that is known as nexus in the jurisdiction. So as noted previously, similar rules apply in multinational taxation and are often made explicit in the permanent establishment provision of tax treaties. It is also result from having a sales force based outside the state that, when traveling into the state, performs substantial additional surveys besides order take talking like bringing in and stocking inventory. So the taxation of electronic commerce under the current US law, states are prohibited from assessing sales or use tax on purely internet sales. Although a customer who avoid a sale tax may end up paying a companion use tax, it is still better for the selling firm to avoid such taxes because a potential expensive accounting system which determine taxes across product type across a variety of taxes does not have to be set up. Sometimes customers do not pay the tax. The seller is then left paying the tax. So we are on the lobbying and tax abatements, and my co-workmates will continue the discussion.
Okay, once again, Panagdait. I am thank you for Miss Rochelle for the introduction. Now I am going to continue the lobbying and the tax abatements. Now, lobbying is when individuals, business, trade unions, groups of charities try to get the government to change its policies. Political persuasion might be a better term. Tax abatements. Tax abatement happens when a local government reduces or eliminates taxes for real estate properties. Cities and municipalities create tax abatements programs for the economic development of certain areas within their boundaries. Next slide, please. Now, we have the Tax Management in Action 7.3. Incentives and location choice. Many cities, states, countries, and trade blocs, such as the European Union, offer firm specific incentives to entice business to locate in their area. Many local governments are beginning to demand refunds of previous incentives from companies that reneged on their promises. Example given is that leaving the area or not hiring as many workers as planned. Similarly, Some localities are awarding incentives over time instead of upfront. Beyond publicized tax incentives, many local jurisdictions provide incentives on a case by case basis. These incentives may include low cost financing. The city or country may underwrite private activity bonds, which may have a low interest rate due to tax exemption to investors. The second, sale or lease of public property below market rates. The third, exemption from local, example given, the city, income taxes, license fees, and other charges for a fixed time period. And the last should be the reduction or exemption from property taxes for a fixed or the tax holiday period. Now, this tackled will be explained to Miss Carpintero.
So, trade-offs with local tax incentives, infrastructure, government costs slash subsidies, and other local costs. Next, please. So, although the tax incentives may be appealing, non-tax factors can easily dominate a location choice decision. Indeed, one reason a local government may offer tax incentives is because some other aspect of the local would not normally attract investors. So, putting it all together, a savant applied to market penetration, penetration the next strategy. Although you have no formal strategic plan, eventually you would like to become a national leader in high-end salsa. So a market analysis reveals that you have no major competitors in either state. All supermarkets sells medium price, national and brands. In the anticipation, you anticipate no major changes in state tax policy in the near future. Value adding, so the total cost of additional sales force would be $300,000 annually. Your market department estimates that you could sell 200,000 units annually at a gross profit of $3 per jar. Internal financing would be used. That is, there would be no cost of capital per se. Thus, per tax economic value adds would be $100,000 annually. So in adjusting value adding for risk, so some brand reputation would be at risk if the product failed in the new state. That is bad publicity, might be preclude a national sales campaign in the future. So since the per tax profit already is low, you are hoping to obtain some tax benefits to provide a risk premium. Next, please. So adjusting in value adding for transactions costs So some major businesses license fees new automobiles for the sale force, and similar expenses are already included in the $300,000 mentioned. So, so the some major businesses license as the before slide tackled that some major business license fees, new automobiles for sales force, and similar expenses are already included in the 300 negotiating. Because you are not locating any operations in the state that might provide significant job, there is little hope of obtaining tax concessions from local authorities. Next, transforming, there is a major tax advantage of the Nevada operations. Any gross profit from such sales will be subject to 0% tax rate. It is transformed to tax-free income. You might not want to use this to drop prices because of your pricing strategy. However, so the tax saving in Nevada may provide enough risk premiums alone to greenlight the new market expansion. So based on the overall business judgment and savant analysis, you decide to proceed with new state campaign. And that would be all. Thank you and God bless.